Hey everybody, Dave here, Hidden Freedom Investing. In today's video, we're going to go over AT&T. We're going to look at the Q2 results for 2020, compare it against the Q2 of last year, see how this pandemic affected the stock, and kind of see where the stock is going. Is it a buy right now? And is it a value trap or is it a yield trap? Well, let's go ahead and get dug in. The information expressed in this video is my opinion and my opinion only. This information is for entertainment purposes only. Please do your own research. Alright, I have the earnings results here for second quarter of 2020 compared to the year-over-year second quarter of 2019. So for AT&T, total operating revenues was almost $41 billion compared to last year's almost $45 billion. So that's a net difference there of about $4 billion. And that was almost a 9% decrease. Let's see, total operating expenses remained about the same. So obviously they lost quite a bit of income, even though the expenses remained pretty much the same. Our operating income decreased by almost 53% there, $3.5 billion compared to last year's $7.5 billion. Net income, $1.5 billion compared to last year's $3.974 billion. That's a 60% decline from last year's quarter. So digging a little bit further here, we have net cash of $12 billion compared to last year's $14 billion. So we did decline about by $2 billion from last year's net cash. Scrolling down a little bit here, we had dividends paid of $3.7 billion for this quarter, and that was compared to last year's quarter of $3.72 billion. Obviously, it doesn't go up too much year over year, but we did pay $3.7 billion. Free cash flow is at $7.5 billion compared to last year's $8.8 billion. So let's go ahead and break down the business segments here and find out why the revenue decreased. Obviously, we know it has to do with the bear virus. Q1 wasn't quite as bad as it was for Q2, and that kind of makes sense because Q1 we weren't in the middle of the pandemic. I think it came out in January or something like that, but it really didn't start hitting us until February. When things started getting shut down and all that. So Q2 was kind of the brunt of the pandemic. I actually expect that Q3 will probably likely go up, but let's go ahead and break down the business segments here. So we have mobility here, and that's kind of the cell phone service, and we had $17 billion for this quarter, and we compare that against the quarter for last year, that was about 17. So that remained about the same. They did see a little bit of a decrease in what they call international roaming, and that makes sense because nobody's traveling, so nobody's roaming around, so why would they be roaming, right? So pun intended. Entertainment group there, I believe that has DirecTV in it as well. That's $10 billion they had a revenue there, and that was compared to last year's 11.3. Unfortunately, they just keep seeing a decline in that DirecTV, and they are really hating that buy, I'm sure, right now at this point. Spent $48 billion, almost $49 billion on that purchase in 2015, and it's coming back to bite them. So we'll talk about that here in a second, though. Business wireline, I believe that's business internet. That remained pretty much the same, although there was a little bit of a decrease in it from last year. And that could just be due to from customers, small business possibly going out of business or something like that as well. But if you look at last quarter, it wasn't that big of a decline. Now it was maybe from the last quarter of 2019. From last quarter, it wasn't that big of a decline. We're just chalk that up to businesses probably not ordering service and maybe even closing service down from going out of business, going bankrupt. WarnerMedia here. So we had $6.8 billion of revenue for 2020 of Q2, and that was compared to last year's about 8.8. So that's a substantial $2 billion decrease from last year, and a lot of that has to do with the Turner here. And we had $2.9, almost $3 billion of revenue compared to last year's 3.4. So that's a pretty big decline. So we saw quite a bit of a decline here in Turner, and that is TBS, TNT, Cartoon Network, CNN, and TBS, I believe, as well. So it's 2.9 billion for this quarter, and compared to last year's, that was 3.4. So that's a substantial decline from last quarter's or last year's quarter to Q2. And it was still a decline from even last quarter, 3.1 billion. So obviously they're cutting down on ad revenue because there's not as many sports being played on TNT, TBS, and TNT. So all the TV series and all that probably got pushed off to 2021. I know a lot of the TV shows that I watch on various different channels, Paramount Network, AMC, and TNT, and TBS, and all these other different channels. There's a lot of series that I watched. Well, guess what? A lot of those particular series got pushed off to 2021. They didn't film, they didn't release at all, so they're losing ad revenue from that. For HBO here, human body odor, that's what we've called it ever since I was growing up, human body odor. So HBO, $1.6 billion of revenue compared to last year's Q2 of 1.7. So that was a little bit about $100 million or so of decline there. And compared to last quarter, we actually had an increase. So that's pretty good. They're probably, bringing on more subscribers to HBO Plus and all that stuff as well. So that's helping out. Warner Brothers, we can pretty much assume that there's going to be a decline there. Disney is getting hit pretty bad. And there's not a lot of movies coming out and all that, but it does look like they were able to maintain last quarter of 3.2 billion. So this quarter they had 3.2 billion, but last year's looks like it's about $100 million short. Like I said, movies and all that are just not in production right now. So looks like it wasn't too big of a hit. The biggest hit here so far has been the Turner network there. And we'll go through their listings, reasons why they had a decline in some of the different sectors here, or different business segments. For communications, we had down 4.7% year over year due to declines in entertainment group, in business wireline, and mobility. And what they're talking about there is they're talking about the roaming, and they're talking about the decline or possibly bankrupts in the smaller businesses internet. And we can see that broke down here in the mobility. Let's see here, due to service revenue pressures from lower international roaming. And like I said, nobody's traveling, so that's the reason why there is a decrease in roaming. So let's go to the next one here. Entertainment group here, we got a 11% year-over-year decline due to premium TV and over-the-top subscribers, impact of COVID related, of course. So the video was down 13% year-over-year due to declines in premium and over-the-top subscribers, which was due to the impact of COVID again. IP broadband, that's pretty much flat. You'd think that people wouldn't be canceling IP, but they could still lose customers to other providers out there, assuming that those providers are, there's other providers in that particular area. This is kind of interesting here. Premium TV subscribers, which includes DirecTV, that's what everybody's probably going to be asking about. 886,000 lost due to competitive or competition, as well as lower gross ads from continued focus on adding higher value customers. I would assume that, they kind of lumped it all in there, but I'm assuming that most of that probably had to do with the DirecTV. They've lost a lot of subscribers from DirecTV ever since they purchased them almost 5 years ago. And that's just sad, but we'll talk about that here later on in this video. Business wireline, so we had 3.5% year over year with decline legacy products. Like I said, that's just has to do with the internet, internet products for the small businesses and stuff like that. So the WarnerMedia here, let's see here. This is kind of the overview of the whole particular business segment, but we'll break those down here in a second. So let's looking at here, 6.8 billion. Down at 22.9% year over year, driven by declines across all units. Now we talked about that earlier here. The biggest decline was in the Turner. So the Turner here, 3 billion, down 12% year over year due to decrease in advertising and subscription revenues, partially offset by increase in content and other. So subscription decreased due to lower regional sports network revenues, as well as international revenues, which were impacted by unfavorable foreign exchange rates, partially offset by higher domestic affiliate rates. Advertising declined primarily due to suspension of the NBA. Yes, if you didn't know, AT&T has a lot of NBA games on there. All right, that was my go-to network to watch NBA, which had a significant unfavorable impact on Turner's domestic entertainment networks and contributed to lower audience delivery as well as lower overall domestic and international demand, partially offset by higher news delivery. And here we got the human body odor, HBO, let's see, 1.6 billion down 5.2% year over year, reflecting a decrease in subscription revenues and content and other revenues. Obviously, if they can't make new content, there's gonna be no advertising there, people aren't gonna watch it, so maybe they even cancel it, right? There's so many different options out there these days, and why would people even stick with HBO if they had to cancel a lot of the programming or something like that, or there's even other options out there, bundled services, or you can get it from some other service, so I mean, it just comes down to competition. So we got the Warner Brothers here, 3.3 billion, down 3.9% year over year due to declines in theatrical and games and other revenues, partially offset by higher television revenues. Decreased primarily due to postponement of theatrical releases due to close of movie theaters. That makes sense right there. Even if they had movies that were going to come out, they got postponed because all the theaters, AMC and all that got closed. They may even postponed even production on some of the movies as well, due to social distancing and all that stuff. Television product increased primarily due to higher sales to HBO Max, partially offset by lower third-party TV production revenues due to product hiatus. If you'd like to see AT&T dump DirecTV, go ahead and like and subscribe and hit that bell notification. So that's the breakdown. It's not as bad as we think. I do think that we are over the hump at this point. I think Q3 will actually have better revenue. Things are coming back slowly. Movie theaters are starting to open up a little bit. Whether people are going or not, they have to wear a mask or something. I don't really know. I'm probably not going to ever go back until the mask thing's gone. A couple of the things here that could be issues going forward. Obviously, we know that DirecTV that they bought back in 2015, that $49 billion that they spent on it, has been on a decline for the last 5 years. They're trying to look for a buyer for it, but honestly, I don't know who was going to be buying that thing. If you think about it, it's like, think about the horse and buggy, the carriages and all that. And when the Model T came out, and you wait, a few years, Model T is becoming more and more popular. And here you're trying to sell off that horse and buggy freaking business. Who's gonna buy it, right? It's a declining industry, right? Who's gonna buy the horse and buggies when you have the Model T mass produced and become affordable and all that? So it's just DirecTV. I think they're pretty much gonna be SOL on that. I don't know if they're gonna be able to find a buyer for it. Now, granted, is DirecTV or is satellite ever gonna go away completely? Probably not. There's people in rural areas that need actual satellite. There's no latency issues with that, satellite for TV. Now, for internet there is, but so people that live in BFE, okay, butt Egypt or bum Egypt, they pretty much need satellite. So that's what they have for internet. And that's maybe what they have for TV as well. More than likely, if they can get internet some other way, they're gonna do that though, because of the latency. So right now, if they tried to sell the DirecTV, they're probably looking at maybe 20 billion bucks, and that's a substantial loss from what they paid. That's a $30 billion loss. I think they just need to cut their losses, get rid of this thing, and cut the debt out of the company if they can. A lot of people just don't like this company because of the debt. They're right now about $153 to $155 billion in debt. They are paying that down. They just restructured some of their debt a little bit here. Probably refinance some of their loans or something down to a lower interest rate. They have about $17 billion of cash on hand right now. Hopefully they don't go out and buy another company. So they bought that Warner back in 2018 for $85 billion. So, they need to pay some of this debt off. They make plenty of money. And yes, they do have a lot of debt. They're starting to pay it down. They're starting to invest some capital as well. I think they just invested some capital into Spectrum 5G. So they are putting some money to work. They are paying the debt down. They are increasing their dividend. So let's go ahead and look at that real quick here as well. So we're here looking at FinViz, and we have a breakdown here. It's a $200 billion company. We got income of $11 billion, sales of about $175 billion. We got a dividend percentage of 7.4%. Everybody loves this company for the dividend, and I can't lie, I do too. So we got 243,000 employees, and we have gross margin of about 54, operating margin of 13.8, and profit margin of about 6.8. It's a little kind of low there, but it is what it is. Forward PE of 8.6. And we have year to date, we're down about 28%. Oh, I forgot the payout ratio is 125%. So looking at Seeking Alpha here, we got a 7.4% dividend yield like we just talked about, but their payout ratio for some reason shows 65%. I think that they're actually using the forward EPS and not the EPS that FinViz is currently showing. So FinViz is currently showing 1.64, and I think that Seeking Alpha is using the 3.23 because that would come out about 65%. We got the 5-year CAGR here at 2%, kind of low, I get that. And then we got the dividend growth here, and this is another reason why everybody owns this stock. All right, we got a dividend aristocrat, 36 consecutive years of dividend increases. So the priorities set forth by AT&T. Let's see here, 2020 priorities. Execute our plan with a market focus on wireless, nationwide 5G and FirstNet, fiber-based connectivity for wireless, consumer and business, software-based entertainment, HBO Max and AT&T TV. Obviously, you know, if AT&T TV, say that 5 times fast like a tongue twister here, if that is actually, you know, pretty reasonable, 20 bucks, 25 bucks, I would look at that, right? Sling's been great so far. It's definitely, I liked YouTube TV better, but you know, for that extra 15 or 20 bucks that they increased it, it just wasn't worth it. I got the same exact thing. So if AT&T TV has a similar offering as Sling TV, but it's cheaper, I would go to AT&T TV. Effective and efficient in everything we do. Key product, drive customer value proposition and brand positioning, aligning operations to market focus, improving the experience we deliver to our customers, ramping transformation and sizing our operations to new environment, managing impact of COVID. Solid balance sheet and deliberate capital allocation. Investing in strategic growth areas, you know, that's what we just talked about above, fiber, 5G, FirstNet, and HBO Max. Committed to supporting the dividend, 36-year record of increasing, so they're not going to be cutting that dividend anytime soon. Reducing debt, maintaining investment grade status, that is key there. Almost everybody's knock on AT&T is the debt. All right, now they're going to reduce that. Hopefully they de-lever, remove that freaking DirecTV if they can find some, you know, sucker out there to buy it. Right? Don't tell anybody I said that. Continued portfolio review, monetizing non-core assets. Transformation, reducing labor costs. Obviously they have 243,000 employees, achieved benefit efficiencies, and began implementing workforce reductions in July. All right, so if you didn't know, they got a new CEO in July as well, and that's John Stankey, I believe his name is. So hopefully going forward, they can cut some costs here. Sorry people, but you know, everybody working from home and all that, they just don't need as many people anymore. Streamlining distribution, close underperforming retail stores, optimizing channel mix, innovating from new environment, rationalizing IT systems and network operations. SDN, that's I believe software defined networking, reached 75% virtualization goal. So if they go to software defined networking, they can probably reduce a lot of the hardware and reduce the cost there as well. System review underway and optimizing real estate footprint. So they're going to close some stores, which should save them some money as well. It's going to reduce workforce and all that, unfortunately, but it is what it is. Simplifying processes and support functions, business sales effectiveness, call center productivity, provisioning, billing, and collections. Go ahead and like and subscribe and hit that bell notification for that 7.4% dividend yield. So AT&T's been on a pretty much sideways movement for the last several months here. And then just recently we're kind of selling off and getting very close to that March 23rd low there, about $26. We're at 28 currently at this point. We have a low here back in May. We have a low here back in April. And so I think that this is a great buying opportunity. And you know, the risk to reward at 28 bucks is there in my opinion. Now, if the market obviously turns over and goes even lower, it's possible that AT&T can sell off more and may even test that that low back that we had back in March 23rd, down near $26. But I think the risk to reward is there. You're getting a 7.4% dividend yield. We'll just scroll back a little bit here. So this is back in what? Back in 2018 when we had the big decline in 2018. You can notice that it pulled back to about the same spot that it is now. So we touched it here, we touched it back in, you know, obviously we went a little bit lower back in March, and we went lower here as well in May, and then now we're back at that point. So we keep retesting that level there. It kind of almost looks like a head and shoulders a little bit here. This could be in the head, and then you got the neck, and then you got a shoulder and a shoulder, which would break down to the downside. But if we scroll out even further here, so here we're going all the way back to like 2011, 2012, and we're at that level now from 2011, 2012, okay? And that's without the DirecTV, that's without the Time Warner. All right, so we're back to that level. So that's a very strong level in my opinion. And this is the buying opportunity for me. So I've picked up some more shares this week. If we look at my dividend portfolio here, and we look at AT&T, which I already have selected, and we have annual income of $754 that I get from AT&T, over $10,000 invested in AT&T right now. So I bought some in my taxable, I bought some in my tax deferred account. So I'm up to 362 shares. I am down 12% in the stock right now. My cost basis is almost $32 a share. I'm okay with that. I feel like the stock is worth more than about $32 a share, or right around $32 a share. I really bought this for the dividend. I don't care about the capital appreciation. So going forward, I will pick up more shares if it drops down below the 28 that it's at now. If we get near that 26, I'll probably back up the truck and load up a lot more shares. I just don't think the stock is going to be going much lower than it is now. Just looking at all those other previous support areas. Now, if the market turns over, all bets are off. We could go and test that March 23rd low. But going forward, they got a new CEO. They're trying to pawn off that DirecTV to another company. I think the pandemic, for the most part, it's not over, but I think a lot of the companies have, you know, passed the brunt of the issue on the reduced, you know, employees. They reduce expenses and all that. So I think advertising has come back as well. So that's my thoughts on AT&T. If you have any comments, questions, or concerns, go ahead and comment below. Go ahead and like and subscribe. We'll see you in the next video. Thanks for watching.